Hey guys, a warm welcome along. In this video I thought I would take a look at this table which was published in the most recent edition of the Investment Times from Hargreaves and Lansdowne. I've had to scan it because as far as I can gather they don't make it available online anywhere, but that's the source. What it shows is major sector performance over the past 10 years or so. As you can see, most of them are organized by geography, and it shows the highest performance in each year first, and then decreasing from there. So for example, in 2012-13, Japan was the highest at 28.61%, and decreases, and the lowest that there's data for in that year was UK government bonds at 5.27%, and then it does the same for each subsequent year. I've managed not to scan it very well, but the last year recorded there is 2021 to 22. And if you take a quick glance at that, you'll see that there's only two sectors which were in positive territory. North America at 6.57, global at 1.04, and all the rest were in negative territory. I thought I would do a bit of an analysis on this. I've done that using Excel. Now, as you can see, these are all color coded. I haven't replicated that in the Excel file, but what I have done is I have taken the data and then organized it by sector. So whereas Japan in the first year, I'll just go back over there. In the first year, Japan was the highest one. In subsequent years, then I've had to go and find the figure. So in the second year, for instance, it was actually the lowest, and so on. So these are organized by sector here, and some of the things that I thought I might find interesting to look at are listed under considerations here. So I thought we might look at stocks versus bonds, the average for each market sector, outliers, risk mitigation, aggressive versus conservative strategies, a comparative league if you like, highs versus lows, and years positive versus years negative. So I've already done a bit of work on this, although it's not complete actually, I'm just noticing now. But for the first year, the top two are the highest performing sectors. So that is Japan and Europe, excluding the UK. I don't know why this is not working for me. No. For some reason I'm not able to highlight that while I'm recording. But so yeah, if we look at that, I've just highlighted basically the top two sectors for each year apart from the first year and the second year. So the second year, quite obviously Europe, excluding the UK, coming in at just under 15%. North America 10.22. In the following year after that, Japan again, nearly 30%, followed by North America. Then 2015-16, quite a lot of negative there, and we see a bit of a change around to bonds being the best performers. So global government bonds 5.5%, global corporate bonds 4.5%. And then in 2016-17 we have global emerging markets at 35, and Asia Pacific excluding Japan at 34. In the following year the best performer was Japan at 15, followed by global emerging markets at 12 this time. Then 2018-19 we've got North America 16%, and global 8.7. The year after that looks like another bad year on quick glance, lots of negatives. So back to UK government bonds 15.3 and global government bonds 7.76. Then in 2020 to 21, I think you would say this was full pandemic time. Global emerging markets did 38%, and Asia Pacific, excluding Japan, did 37%. Then in the last year that there's data for present, North America, we already saw this on the multicolored one, the table, 6.5% against the global one at 1.04. So the first thing that I did was to do an average for the 10 years and basically have a look to see what it looks like. So the best performer in terms of the average over those 10 years was North America at 15+%, and the second best was global at just under 12%. Now, this may give you some insight into why people talk a lot about the S&P 500 as somewhere to invest, and as far as I can recall from the J.L. Collins book, The Simple Path to Wealth, over a roughly, I think it was a 40-year time period, he had looked at the figures and had discovered that the average annual growth in the S&P 500 over that time frame was in around 12%. I think it was maybe just shy of that. So this 15 is perhaps a little bit misleading, but in comparison to the other options, if you like, it does it does show that that the American market is strong, and certainly has continued to be strong in the last 10 years. And if you were less convinced, let's say, by wanting to solely invest in the American market, a global fund should do the trick pretty well also. Now the things that are highlighted in green, you can see that they are generally lower percentages, and those have highlighted those because those are the bond sectors. So the highest performer of those was global high yield bonds at 5.22%. And as you can see, the lowest performer there was global government bonds at 2.05%. Sometimes people talk about using bonds as kind of like a hedge to market volatility, or a good way to diversify, if you like. And you can see the logic actually behind that, because if you look, as we've already kind of mentioned, 2015-16, the two best performing sectors were bonds, whilst everything else was hit pretty hard. Although even with that, if you look at the North American market for that period, it still performed positive at 2.7%. Another bad year was 2019-20. The American market then was positive 2.4%, as compared to well, UK government bonds were positive 15.3 that year. But look at the average for that overall. You know, the over the 10-year period, you're talking an average of 2.6. So yes, it would have been lovely to have that 15%. But to hit it once in 10 years, is it really worth it? I, personally speaking, am leaning more towards investing entirely in stocks and shares, and particularly the American market. Perhaps I may diversify into some kind of a global fund as well, just to try and protect myself from possible future changes, such as the rise of China. As things stand, I don't honestly believe that Russia is a serious contender on the global stage. So even if they were, a global fund should give you some protection against the competitive things changing. So what else have I mentioned here? Stocks and bonds, the average for each market we've already looked at. Outliers, well, I suppose we've kind of already mentioned that in terms of the bonds. Now I've highlighted the positive figures in this. Let's have a look and see what the kind of worst negative would be, if you like. So that one there, 2015-16, global emerging markets took a hit of 9.76%. We've got no negatives at all in 2016-17. That's so small that it's nearly insignificant. -4 there, I don't see anything bigger than that. That was Japan. That reminds me, Japan, hold on a minute, Japan. Oh, here I've missed a couple of years at the start. Let's go back, right. So yes, Japan, in the second year of this table, after achieving nearly 29%, fell the year after by 11.3. Let's just have a look at what the average was for Japan. So it's actually coming around 9.86 for that 10 years. It would be interesting to see that over a longer time frame to see, is that about right, or is it higher or lower on a longer term basis? But certainly in those couple of years it seemed to be quite variable, and in fact that variability looks to continue, because 2015-16 you've got -1 and then followed by 27, a couple of years later -4, and -6 in 21-22. So there's quite a bit of variability on that, and that accounts for the average being that bit lower. So yeah, I was looking for the highest negative figures. I don't know if we had seen that one already or not, but yeah, we had. So that one, what else have we got? It's not massive, but it's still negative. And there's quite a significant one there. That was a bad year all round. So that was all UK companies. 2019-20 took a pasting, down almost 15%. There is UK government bonds. Look at that. In that year there, where you had the growth of 15.3%, you were followed then 2 subsequent years by drops of 7.97, 7.75. I do understand people want to protect their investments, and from that point of view I can understand putting money into bonds, but for an average growth of 2.6%, I would say I'm honestly not convinced it's worth it. I think you're better to perhaps build a cash cushion, an emergency fund which you can use for a period of time whenever the markets crash, until such times as they recover, or almost. My personal take on things is I want to have an emergency cushion of around about 4 years. I think that should be sufficient. And at the end of the day, there's only so much you can do to protect yourself from volatility. But I mean, growth of 2.6% is well below the safe withdrawal rate that's usually quoted as 4%, 3.5% if you're looking for longer term protection. Certainly the global high yield bonds look the most attractive there in that. Right, what else have we said we would consider? So outliers we've looked at. Risk mitigation I've kind of talked about. Aggressive versus conservative. So aggressive, I suppose you could say, well, if you were going to be aggressive, you might go for the sectors that have produced the highest return, but you need to factor in, are they consistently the highest, or are they volatile? And I mean, in particular, if you look at Japan, I've already said, you got 28.6, minus 11, positive 29, minus 1, positive 27. Okay, on the whole it isn't, the negatives aren't awfully bad, but it does hit the average quite substantially, and as compared to the American market, it's just not there. So I think you're probably better to go a little bit more conservative. Now that said, I mean, if we look at the numbers of times that Japan is in the top 2 for the 10 years, you've got 3 occasions. Europe, we've got only 1. North America, only 3 occasions actually. I thought it might have been more than that. Asia Pacific, excluding Japan, we've got 2. And the UK, absolutely none. Global, there are 2. Global high yield bonds, none. UK corporate bonds, none. Global emerging markets appears there 3 times. Global government bonds twice. UK government bonds once, and global corporate bonds once as well. So comparative league, highs versus lows, years, positive versus negative. Well, I mean, you can have a look at that yourself and figure it out. I'll put this file online and link or explain how to get to it in the description for the video. But I do think it is interesting just to have a look at. I suppose, I mean, if you were to have a comparative league, you might order these in terms of the highest percentages. So clearly you've got North America number 1, global number 2, Europe excluding the UK in 3rd place, Asia Pacific excluding Japan in, no, am I right there, or is Japan next? Yes, Japan next, followed by Asia Pacific excluding Japan, and I think then after that you're looking at all UK companies. I'm surprised at that. That's interesting. So all UK companies, you're looking at an average of around about 8% for that 10-year period. And beyond that then, well, frankly, you're starting to fall into the realms of not perhaps really the performance that you need in terms of financial independence and retire early. Obviously, there will be years where the market is negative, and you want probably as few of those as possible. In that last 10-year period there, just looking at North America, there's not actually a single year where that market sector was negative. I wonder, are there any others that do not have negatives in them at all? I would think it's unlikely, but I'm just scanning down quickly here. No, all the rest of them have a negative somewhere in there. And frankly, the American market does have negative years too. There just simply hasn't been one recorded there in that past 10-year period. Guys, I hope you find the analysis interesting, useful. If you do download the file and do much else with it, I'd be very interested to hear about it in the comments. See if you discovered or noticed anything of particular interest. And yeah, please feel free to comment. Of course, if you like the video, that helps to spread the word. And if you are interested in following the journey, please subscribe and you'll be notified when more content goes up. Have a great day.